Economy slowed down in the second quarter. What does that mean for the second half? What does that mean for consumers? And what does that mean for the Federal Reserve? That's the big question. Talking about here this morning on the Markets Hub. Good morning, everyone. It's Friday. I'm Paul Vigna, joined by Phil Izzo at the top of the show here, because we're going to talk about that GDP number that came in this morning.
Yeah.
Little bit better than the market anticipated, but it certainly did not show a strong economy.
It's not a good news report. I mean, yeah, the consensus was about 1.3. We came in at 1.5, so that's a little better than anticipated. But if you look at the last three bars of the GDP number,
and you can see them right there.
You look at fourth quarter, first quarter, second quarter. That trend is pretty clear. You're slowing down.
We are decelerating. Still growing, but at a lower and lower pace.
At a lower and lower rate. And I mean, that's what we've been seeing for the last couple of months, that things have sort of stagnated. And if they keep going like this, I mean, that's just bad news. 1.5% growth is not enough to bring down the unemployment rate at all. It doesn't, I mean, that means stagnant jobs.
A lot of people, I think including Ben Bernanke, have said that this is roughly an area that's it's stall speed, basically. Get the image of an aircraft flying, one of the engines goes out, or two of the engines goes out. You know, you're still moving. But you are very vulnerable.
This is the kind of economy that if you get a shock, it's very easy to fall into recession. Something happens in the Eurozone, something happens in the Mideast, oil prices spike, anything like that, we're in a very vulnerable
Congress doesn't act, you know. And you can see here's some of the details of it. You know, it's interesting, Phil, you talked about how you can see the deceleration growth. Look at that personal spending number, because that's another place where you see the economy slowing down. People are spending less and less.
Well, there's one caveat in that personal spending. It's definitely not a good number, and it's still a really low number, but it reflects primarily a pullback in the auto sales. The auto sales had a really strong first quarter, and then second quarter they pulled back a little bit. And while we saw, I mean, again, it's below 2%. In even the other categories like services and non-durable goods, which is not great. But it's not totally hopeless on the spending category, but we also got consumer sentiment numbers today, which weren't so good. So, you know, it doesn't seem like the consumer is excited about anything, that's for sure.
Well, what do they have to be excited about? I mean, really, let's talk about how this affects, this is what the market really cares about. Let's talk about how this report affects the Fed and their thinking.
QE or not QE, that's
to QE
that
or
is
not
the question.
To QE,
Yeah, I think that this market doesn't substantially change where the Fed stood. We've reported in the past that the Fed is biased towards more easing, that they probably that they're closer to action than not action, but at the same time they're data dependent. They need to see that things are going to get worse. So I think that probably next week there's a good chance that the Fed won't necessarily act right away.
What is the FOMC
the
meeting?
FOMC meeting is next week.
There was some speculation that they would act.
And they might. There are things that they could definitely do next week to signal that they're going to. But a big quantitative easing program beginning next week.
Well, especially after this report.
Right. Exactly. The report doesn't. It definitely doesn't force their hand. It's not so bad that they have to do something, but it leaves them room. If you look at the inflation data, I mean, that's the number one concern of the Fed. Is inflation going to run? I mean, that's what holds them back from action. Is inflation a big risk? If you look at all the inflation data in this report, everything is below their 2% objective. So it doesn't hold them back, at least.
And I'll give you, we have to leave it here. I'll give you one decent takeaway from this. If you want to look at it this way, it wasn't as bad as you're seeing elsewhere.
That's true.
Growth rates in Europe are bad. We got the UK this week. It was very bad. China's slowing. How much is open to debate depending on the data. But, you know, this wasn't a great report, but it did not show the kind of rapid deceleration you're seeing elsewhere.
You're not seeing negative numbers.
There you go. I'll give you a good takeaway. All right, Phil Izzo, thank you very much.